Welcome to the Daily Drawdown, where SpaceX financing and AI infrastructure are moving markets. The big tell right now is financing. SpaceX, hyperscalers, chip suppliers, and power developers are all leaning harder on debt and long-duration contracts to fund AI scale. And that makes funding conditions the market variable to watch. SpaceX followed its huge public listing with a roughly $20 billion senior unsecured bond deal aimed at refinancing bridge debt and funding AI-related capex. That landed into an already jumpy stock, and the reaction was brutal for a day. Shares had already swung from roughly $135 to $225 in the first week, and the bond news helped trigger a sell-off that erased about $400 billion in market value. The message from the market was simple. Investors like the growth story, but they are highly sensitive to dilution risk, leverage, and the sheer cash demands behind the AI expansion. Even with ratings agencies giving it investment grade or near investment grade treatment in some coverage, reported debt rising past $128 billion puts the focus on execution and funding discipline, not just vision. The bullish case is still enormous. Analysts are attaching addressable market numbers in the $25 trillion to $28.5 trillion range across launch Starlink broadband and AI compute. That sounds extreme, but the core support is real. SpaceX has handled more than 90% of payload tonnage to orbit over the last 2 years, and lower marginal launch costs are central to the model. Forecasts that put launch costs closer to $3 million to $5 million per flight, down from roughly $14 million, are what make the margin and scale math work if they actually materialize. The key distinction is that current dominance in launch is tangible, while the multi-trillion revenue scenarios depend on future services, especially compute, scaling far beyond what exists today. The practical new development is that SpaceX is starting to look less like a pure launch company and more like an infrastructure platform. A reported Reflection AI contract at about $150 million a month, or roughly $6.3 billion through 2029, gives a concrete example of recurring compute revenue tied to data center capacity. Separate reports of interest from Anthropic and others point to the bigger strategic idea, bundling low-latency compute with Starlink connectivity and eventually selling orbital or LEO-linked AI infrastructure as a service. If that model works, SpaceX gets recurring revenue streams with a very different profile from one-off launch economics. Zoom out, and this is bigger than one company. Hyperscaler capex is consuming historically large shares of cash flow, and the whole AI stack is reaching deeper into credit markets to stay funded. Apollo's reported $35 billion financing package tied to Broadcom's AI platform and Anthropic compute needs is a good example of the new structure. Banks start the debt, longer duration capital follows, and everyone assumes the build-out keeps going. That is why banks, private credit, and capital markets desks are major beneficiaries of the AI cycle. It is also why credit spreads matter more than the day-to-day equity tape. If liquidity tightens, AI investment continuity becomes the immediate risk. At the same time, the revenue side of AI is getting more competitive. Open source and lower-cost models from China and elsewhere are pushing customers to minimize token spend and route basic workloads to cheaper models. A lot of buyers are moving toward orchestration. Cheap models handle most of the work, and expensive frontier models are reserved for the last small slice of high-value tasks. That matters because it pressures pricing power for premium closed models, just as infrastructure owners are spending aggressively to support them. So the market is funding AI like a scarcity business, while parts of the product layer are already behaving more like a commodity business. The cleaner beneficiaries are still semis, memory, power, and grid equipment. High-bandwidth memory demand continues to re-rate names like Micron, with shortages and upcoming earnings still acting as major catalysts. But valuations are stretched across the space, and options markets are already pricing large moves. So good news increasingly has to be very good news. On the power side, the bottleneck is still real. Chevron's 20-year deal with Microsoft for up to 2.67 gigawatts of gas-fired capacity in West Texas shows where the market is going. Long-duration power security, behind-the-meter economics, and stranded gas turned into data center fuel. That keeps industrial beneficiaries like GE, Vernova, Quanta, and Vertiv squarely in focus because backlog visibility is one of the few things this market is willing to pay up for. Permitting is no longer a side issue. Pennsylvania says it has cut permitting times by about 72%, while also forcing developers to secure power and meet community and environmental standards before projects move ahead. That is the template to watch elsewhere. Faster approvals for serious projects, tougher screening for speculative ones, and more pressure to prove grid readiness upfront. For investors, that shifts some value from pure land and concept plays toward operators that can actually lock power, financing, and local approvals. In the stock market, leadership has broadened. Mega-cap tech has lagged recently while banks, industrials, infrastructure suppliers, and small caps have picked up the baton. The Russell 2000 moving above 3,000 and gaining roughly 21% year-to-date in some coverage reflects that broadening with biotech, regional banks, and AI-adjacent small caps helping. Some strategists still view the mega-cap pullback as a buying opportunity around 18 to 22 times earnings, but the concentration risk in a handful of names has not gone away. A market that depends on a few giant balance sheets to fund the next leg of AI spending is still a fragile market structure. On macro, the Fed story is less about the last meeting and more about communication risk. Under Chair Kevin Warsh, statements have reportedly gotten much shorter and forward guidance lighter, which may reduce policy overcommitment but increases uncertainty in rate pricing. That comes alongside criticism that the Fed missed inflation targets for too long and needs deeper operational reform, not cosmetic changes. In energy, Swiss-mediated U.S.-Iran talks and a temporary U.S. license for some Iranian oil sales helped pull WTI below the mid-$70 in some coverage. But the deal looks fragile, and threats tied to Hezbollah-Israel tensions, the Strait of Hormuz, and a Qatari gas plant explosion keep both oil and LNG markets exposed to sudden upside risk. Three things matter most from here: whether AI funding stays cheap, whether infrastructure owners can turn CapEx into durable recurring revenue, and whether model layer pricing keeps compressing. For SpaceX specifically, watch post-IPO lockup dynamics, debt market reception, and whether compute contracts scale fast enough to justify the jump from launch leader to full-stack AI infrastructure name. For the broader market, credit conditions may tell you more than the Nasdaq does. That's the brief from the Daily Drawdown. The story is still growth, but the market is starting to price the bill. This episode was generated by Podkey. Create your own at podkey.fm.